This is your LMAX exchange technical update for Monday, April 3rd, 2017. Euro dollar. So the euro has pulled back over the past few sessions, with the market coming back into the middle of a critical range between 104.95 and 109.05. At this point, it's difficult to determine whether we're going to put in a higher low here at a fresh upside back above the recent highs at 109.05 and to confirm this inverse head and shoulders formation, accelerating gains up towards the 114 area, or if these setbacks are just the start of a more significant bearish resumption back towards that recent support at 104.95 from February, exposing a drop below there towards a retest of the 17-year low from 2017 in January at 103.40. A break below that level would then expose parity further down. But having said that, this latest setback is coming into some critical support here in the form of some key fib support and Ichimoku support. We've come back into the 61.8 fib retracements off of this move from 104.95 to 109.05, which comes in around 106.50, and the market is starting to show support in that level. But if we break lower, there's still a lot of good support between 106.50 and 105.80. 105.80 is the 78.6 fib retracements, and also between 105.80 and 106.50 is this Ichimoku cloud. So really only a break back below 105.80 now would compromise what could be a corrective pullback and open the door for an acceleration of decline. So any setbacks that we see from here to 105.80 could still see the formation of a higher low above that 104.95 low that we saw going back to the 22nd of February, and a fresh upside back towards and above the recent highs that we saw at 109.05. So that's going to be the key level to watch this week, 105.80. If the market holds above 105.80, then there is risk for a higher low, but if it breaks down below 105.80, then we could see an acceleration back towards that 17-year low at 103.40, below which exposes parity. Sterling dollar. So cable has been very well capped into rallies over the past several months. This is a market that's been in a consolidation, but the consolidation is classified as a bearish consolidation given the broader downtrend. And while we hold below the December 2016 peak at 127.75, rallies are expected to continue to be very well capped up into this resistance zone well ahead of 127.75 in favor of the next downside extension back towards the 2017 low at 1987, which guards against the October 2016 plus 30-year low at 118.40. For now, this week, key levels to watch above and below. Above, we want to pay attention to the high that we saw last week, which came in around 126.16, and the recent low that we saw last week, which came in at 23.77. So a break above or below will be required for clearer short-term directional insight, but again, it's going to be more significant if we see a break back below 23.77, which will likely open the door for the next downside extension and a resumption of this range trade and downtrend back toward the 1987-2017 low. Dollar yen. So despite a little bit of a bounce last week in dollar yen, the market continues to be very well capped, and following that breakdown below some critical multi-day range support at 1160, there is still risk for fresh downside in this market below the recent lows that we saw and below the psychological barrier at 110 down towards a measured move at 107.60. At this point, we would need to see a break and close back above the recent high from this previous week, which came in at 1220, to take the immediate pressure off the downside, but overall it would take a break all the way back above 115.60 to force a shift in the structure. Euro Swiss. Euro Swiss remains confined to a downtrend, with the market now looking for a lower top at 108.26, which will be confirmed on that next downside extension below the 2016 low at 106.24, exposing a drop down towards the 104 area further down. Aussie dollar. So Aussie continues to be very well capped on rallies up towards 78. This is a resistance level that has capped rallies over the past several months, and the market is now looking like it wants to roll over with a break and close below recent support around 75.88 to strengthen this outlook and accelerate declines back towards more significant support going back to early March at 74.92. Dollar CAD. So dollar CAD has seen some setbacks in recent trade, though ultimately here the market continues to be very well supported on dips, and the overall chart is quite constructive, and so setbacks should continue to be very well supported in favor of a higher low, which could be now at 32.64 ahead of the next major upside extension back towards and above the recent multi-day peak at 136 and towards the 140 area further up. Kiwi dollar. So Kiwi has been rounding out what could be a lower top now in place around 70 1190, that high that we saw back on the 21st of March, ahead of the next major downside extension. We would need to see, though, a break back below 68.62, the low going back to the 23rd of December of 2016, to confirm or strengthen the bearish outlook and accelerate declines down towards 65. But any rallies that we do see in the interim should continue to be very well capped, ideally ahead of 72, with only a break back above the 2017 high at 73.76 to compromise this outlook. SPX 500. The S&P 500 has seen a nice bounce out from recent drop that we saw down towards the 2320 area, leaving the broader structure quite constructive. But at the same time, there is signs following this breakdown that we saw earlier in March below 2350, signs of a potential onset of a correction. So look for this latest rally to potentially stall out up here into this resistance zone ahead of 2380 in favor of what could be the next major downside extension below 2300. But of course, we would still need to see the market trade lower and break back down below 2320, the low from the 27th of March, to strengthen this outlook and accelerate declines. Until then, there is risk for a bullish resumption to fresh record highs beyond 2400. Gold. So gold has been a market that's been very well supported on dips over the past several months, really since basing out in 2016, just shy of 1100, with the market putting in a higher low at 1180 going back to January of 2017, and then a higher high at 1265, looking to most recently the 27th of February high. So the latest pullback has been supported now above 1180, and a higher low is now sought out around the 1200 area, which will be confirmed on a break above 1265, opening the next measured move upside extension towards the 1330 area further up. Only back below 1180 would compromise the constructive outlook for gold.